The Nasdaq is doing business as always. Hi folks, I'm Gonzalo Moreira, and in today's video you will understand why the current correction in stocks is so often compared to the 2008 crash, why it reminds us of that time, and not from a macro perspective, just by listening to what dynamic support and resistance lines have to say. The price tells us everything, it's written on the wall. To do that, we have to go down in history a little bit and really see what happened 20 years ago at the bottom of the dot-com crash, then in 2008, the crash and the recovery, because the price action from those times gives us some vital clues to what the Nasdaq can do in the following weeks. So let's go ahead with the analysis. Here we are with a weekly chart of the Nasdaq. Some drawings here already on the chart. Let's start by going back here, perhaps on the monthly to start with, and see where these lines come from and what is the meaning of this all. Okay, so we see here, just for your orientation, the 90s parabolic move, then the crash, the dot-com crash, then the recovery until 2007, and then the capitulation here, 2008, recovery, okay, and then this whole move that we had since that bottom, and then the 2020 dip here to that same support, and then the parabolic recovery. Here we can go on the weekly again, and then we see that that steady recovery from those lows, and then the most recent correction. Okay. This is where we are. So we are still within a normal retracement parameters here in on a logarithmic chart. We see that we haven't still invalidated that dynamic support that goes back to 2009, and this is telling us that so far this is business as always. This is a normal correction. Okay. The reason why we are having these comparisons to what happened then, this is what we are going to see just by looking at the place where this retracement started. Okay, so we topped here at 1600, 600 more or less, and this resistance, this dynamic resistance, to what corresponds? This corresponds to this final capitulation here in 2008. Okay, but what happened before that? Before that, we have this this low here. This was the low from the dot-com crash in 2002, and then we had this steady recovery here, and in 2007 we have the first attempt to regain this descending support from those highs. Okay, we had that first attempt. Then we had a second attempt, a lower high here, yeah, because of this descending nature of this dynamic resistance in May, June 2008. Okay, the market was unable to break that line. This was a very bearish omen already. Okay, not only that, but in the meantime, this support goes back here that helped the market sustain the recovery here in 2006 was lost here initially in January 2008. It was then retested from below at the same time as the market was unable to cross over that descending resistance, carrying all the significance from that high that lasted until the 2000 year 2000. Okay, so this throwback here, and then this minor low here, that here the cards were already on the table. It was clear that the market was not going to have the strength to recover from this crash. So the lines that go from here, from this low here in 2002, this line is the one that we're almost there to reach at the end of last year. Okay, there was perhaps just a slight 10% more, 11, 12%, and we would have reached that target. Yeah, and the significance that this would have had for the market, yeah, would be very positive, because by then the market not only recovered all this affair here, because look at the way the markets then started this whole recovery here, this whole bull market from 2009. So we retested that ground twice, and then look at the play here with this descending line once again. The market immediately bumps against the line. There's a small reaction, but then it hurdles that line and retests it from above. It retests that line, spurts higher, and then by pulling back, it's already pulling back, and I will zoom in so that we see exactly, because these nuances are very important, will be very important for what the market is doing now. Okay, on this second pullback, it pulls back here to the same line again, or in the nearby. Okay, we're looking at here the weekly chart, so oftentimes the weekly candles do not match exactly, but we see this pullback, and the second pullback is already higher than the previous low. Okay, when we have these higher highs, higher lows that we know from traditional technical analysis, immediately we have to assess what is the angle and where was this dynamic angle seen in previous crucial historic moments in the market. So by pulling back here and reacting to this line, okay, we already seen. By then we could have just played around with this line here, around here, and see if that matches this second pullback. And from then on, we can even go here, and for trading purposes, we could have just have gone here and drew a parallel of this line, and then put it on the top here of this line here, or on the top of this two red candles. And here we see, if you zoom in, we see the significance, yeah, because we have a runaway gap here. Okay, a runaway gap. We have here another gap at the opening. Okay, so this fast anxious movements in the market. Okay, so what happened here will tell us what can happen here as well inside this triangular area here, because vital clues we will have as we see the market reacting to these lines. We are now encapsulated in this triangular shape here that has its apex here in June next year. Okay, usually the breakout or the breakdown or up happens at the 2/3 of the triangle. We're not sure if we are going to develop a triangle shape here, or a sideways moving market, or if you are just staging other types of other patterns. But in any case, we want to exactly see how the market will react to these lows, okay, to this support here especially, because this support here, and not only, we'll also see, I want to see how the market breaks from this overhead resistance here. But just in a minute, I'm going back here to this support here in 2020. This reaction here, this very fast reaction, was extremely positive. What significance does it carry for us? Where does this line comes from? This is the line from the low here in 2009. So by reacting so strongly here, the market was just saying this was what was happening here with the pandemic induced crash. Yeah, the market was telling us this is not 2009 again or 2008 again. Okay, we're going to buy this, and the dip was bought heavily. Okay, and not only that, but from that moment on, the market sustained that pace of advancement to a point where it started trading at the higher sides of the entire ascending channel that we see here. Yeah, even higher. Yeah, in 2021, even higher than the levels that we've seen before. Okay, if we duplicate this line here, for instance, this intermediate line, and we place it here on these tops, we see that the market was able to break that line and call it support, use it as support, yeah, for a last spring higher to this level. And the fact that we lost this level was already a first negative signature, yeah. And then again, these vital clues from this slightly inclination in double tops and double bottoms, as we see here, this slightly lower low, it was responding to a level or to an inclination angle that was very well known for this market. Okay, I'm using just parallel lines for a reason, yeah, and you can use any angle. You just have to find an angle that is sustained over time, yeah, and that explains the chart for you. And angles change, obviously. If you go down here into lower time frames, into the dailies and intraday, these lines become almost flat, right? Because we're on a weekly. If I go up on the monthly, they become steeper. So you have to find this same play on lower charts again and again, even to the 1 minute. The angles are within the DNA of that market, and that will repeat. So by staging here a lower low with this known angle, yeah, the market was giving a second signal that it has this unfortunate event here of not reaching a technical target, and then it was reacting to a descending resistance. So it was clear we want to go down. And then we lost this layer of that was once resistance, was lost in here. It was bought here heavily, yeah, but then was lost and then was retested from below. So we are now in a kind of no man's land, I would say, in terms of trading. So for any commitments here, it's still risky because the market could still correct another 10% or so. This is the bottom of this descending channel. Not sure here what will be the bottom if we start developing a downward sloping channel here. But in any case, I pointed down a red circle here. If we lose that ascending support that was heavily defended here in 2020, if we lose that, then we definitely enter a serious or more serious bear market, because we lose significant support because of the origins of that support, and then we start trading within this descending channel marked by this descending resistance here, and perhaps this descending resistance here that I'm going to bold it now for you, okay, within this channel. And then we have a greater channel, because if we lose that level, that ascending support, the message, remember, will be, okay, we lost a support, a dynamic support that goes through the low of 2020. So the low of 2020 in terms of nominal price is going to become the new target. And then if things get even worse, the market's going to look for any dynamic support that goes through that low even lower. And then the channel is established. This is the down path here that I've drawn on the chart. And the whole area here for shorter term traders would be seen as an only short area. That is if you prefer to simplify your trading and adopt one direction only. So by losing this support, I would say preferred positionings are short. Here inside this triangle is neutral, at least from a longer term perspective. At least from a weekly perspective, we can then dig lower into in future videos on lower time frames, not just to make this video too large. And then if we overcome this descending resistance from this historic top here, then obviously the market is going to look to reach that level in terms of price, and then to reach the ascending line that passes through it. And not only that, but the market will try to reach that line that it couldn't target here, at least, if not then higher to those lines that go back here to these levels. Yeah, but especially these lines from this reaction highs here and this in this area, these are the significant lines. Okay, so important intersections, just to add here to the picture, and here around, depending on where we stage this support, if here or using this other line here, we get two different intersections here in September, and then November we get an intersection here. So around these dates, expect any significant change in the structure of the market. Okay, we could have a move higher from here, and then you see that there is another intersection here, coincident with this other one. So reinforcing that idea that we could have a change in the market again here. So we could have a sprint higher here, and then we could lose that resistance again by the end of the year, and then later we would have to analyze if there are more chances for a break higher or lower. In any case, around those dates, expect any significant change in the chart structure. It could be also an acceleration. Not only reversals do occur at the intersection, but also accelerations in the trend. So we could see could lose support, this important support between these coming months, and then later on, 2024, we have another very significant intersection. This is the apex of this potential triangle, but this is just too far ahead now to be useful for us. And then just a brief look at the Nasdaq from an arithmetic perspective. We see this correction going down here to 9,800 more or less. This was here the breakout in 2020. This could be the target if we lose this ascending support. Here on the arithmetic chart, we are already at an important and significant support. So this could be defended, and we have a very steep line here of resistance from that top. You see it makes sense here within this chart, because of the market was responding to this angle from both sides on the top here, but also on staging these lower lows. It's following the same angle. The buyers are defending this level. So a break of this line here, we have an important intersection here coming in September that I haven't marked in a chart, but the market could stage something like here. Here is the intersection. Here is the intersection, so we could see something around this date, and this could be a breakout. Yeah, because this level is important as well. The 2000 or the 13,000. Yeah, this was a level that was retested here from below. Okay, so that level, and the intersection comes about in beginning of September as well. Okay, so summing up, the Nasdaq is under normal retracement parameters so far, and could even go down for another 15-17% without changing the prevailing trend to bearish. Okay, from bullish to bearish. Then from September to November this year, we could see some important technical changes in the Nasdaq. This could be a reversal or an acceleration of the current price deterioration. Key levels to watch are from 9,800 to 10,500, and then the dynamic support as is currently at 12,500 and descending. This one here on the logarithmic chart. Okay, in December it will be at 1200 because it's descending at a slow pace. This is from a logarithmic perspective. From a arithmetical perspective, we can add the importance if the importance of the overhead 13,000, a level that was once support, flipped polarity, and could become support again on a breakout and pullback play, and this will open the doors to an acceleration higher. Okay, folks, hope you like this video. Please make sure you comment, like, subscribe, and if you'd like me to cover any specific market, please let me know in the comment section below. Until the next time, trade safe.